Hi, welcome to Slot Leader, a Cardano finance podcast where we bridge the gap between the world of business and finance and the world of blockchain technology. I'm your host, Umed Saidov, and in today's episode, we have somebody special from the Cardano community, somebody with the background in business and consulting, building a decentralized financial application. In this interview that we have with Dewayne Cameron, we will be discussing blockchain, we'll be discussing economy, and the implication of blockchain and cryptocurrencies in this space, and what he tries to solve with his decentralized finance application. This interview is filled with a lot of interesting insights. I really had a lot of fun talking to Dewayne, and I hope you enjoy it too. Before we go on, I would like to thank everybody who's been watching and listening to our podcast. Slot Leader was created about 2 months ago with the hope of creating the type of content that would take all that knowledge and experience that I've had in the blockchain industry and try to apply it in real-world financial and business applications. And I'm glad that we have such a strong following in the Cardano community and outside of it who are interested in this subject. So thank you so much for being such avid supporters of this podcast. And I hope I will be able to continue doing this and create the type of content that you find useful. If you are a Cardano stakeholder who would like to support this podcast, you may do so by delegating your stake to Skylight Pool. Skylight Pool is a professionally managed Cardano stake pool that's been there since the ITN, and we've produced a lot of blocks and a lot of great rewards for our stakeholders. So if you're looking for a pool to delegate to and you like the type of content that we're putting together, you might want to consider our pools. The tickers are Sky and Sky2. As always, I would like to remind our viewers and listeners that Slot Leader is an educational podcast, and as such, we do not provide investment, financial, tax, or legal advice. As you know, every week I look through the blockchain industry media to look for events that have significant economic or regulatory implications for the space. And in today's episode, I would like to discuss the SEC's recent announcement to establish a standalone office for digital assets and blockchain. I think this signifies that the space is mature enough to be looked at by a regulatory watchdog and probably define a separate set of rules for this asset class. I don't know exactly what will come out of this new initiative, but I think it bodes really well because it probably will lead to a separate set of rules and regulations for this space. In the Cardano community, we saw the monthly update this week that laid out the next steps for the development of the ecosystem, Cardano's ecosystem. And of particular importance is the fact that Cardano is moving into a space where we will be integrating a lot of different kinds of languages onto the platform. I think Charles Hodgkinson's video, the Blackboard bit video, does a really good job of covering what is about to come. And for those who are interested in finding out what they can build on Cardano and what kind of languages potentially could be used, and I will tell you, there's a hint in there that Cardano will be pretty much language agnostic if when the vision is materialized. So if you would like to know more about what is about to happen, I will put those links in the video's comment section on YouTube. Hi, ladies and gentlemen. I have Dewayne Cameron. He is one of the Cardano members, one of the important Cardano community member, and he is building a dApp on Cardano that will provide liquidity to different markets in Africa. I'm going to let him talk about this particular app. But before we do that, I would like to welcome Dewayne to our program. Thank you so much for making time. I know you're busy. You're working for a consulting company out of Philadelphia. So how are you doing today?
Hey, I'm good. Umed, thanks for having me on. I really appreciate it. Been with Cardano since the start of this project. Our team members at Liqwid are, really excited to start building our entire protocol in Cardano, the rollout of the system and Project Catalyst. So it's a great time to be a part of this community, and I'm excited to, talk about all that today with
Yes, Dwayne. So I know that you are one of the prominent members in the community. I know you're pretty active in Twitter, and as somebody who's also coming from the finance background, it's always refreshing to see somebody with that much depth of knowledge and understanding of digital assets, especially Cardano. It's not an easy sort of task to understand and explain digital assets. Cardano could be a little bit harder to explain, but you do a great job of sort of evangelizing, so to say. And can you tell me how you came across Cardano and why you liked it?
Yeah, that's a great one. So I think the time was around mid 2017, kind of like Q3 2017, and I was just first year business student, really kind of learning about the entire crypto space. Ethereum, I think, was really my entrance into the space and the entire idea of smart contracts and even what wasn't named DeFi, but what was already DeFi. This concept of prediction markets and order books that were trustless in this decentralized cloud that anyone could interact with. I just was really fascinated by the whole idea. Like I said, at the time I was studying finance and business and gearing up to really kind of enter as a investment banking analyst or a banking analyst or consulting analyst. So I was in this kind of thought process already. Crypto really aligned with what I was seeing in the current financial markets. Um, as a real answer, as a real solution. Obviously, Bitcoin was booming at this time and the whole market was going up. So that kind of increased the fuel, I guess, to that rally. But I guess hidden within all of that was this real keen interest in Cardano as a project early on. I mean, I remember, after really going down the Ethereum smart contract rabbit hole, the next thing I saw was Cardano. And the first video was that Charles whiteboard video. And I think everyone knows that initial video. And that 3 hour long kind of breakout of each component of the system and what they were really going to build over the next 3 to 5 years. And I think from then on I was pretty much team Cardano. Even I didn't know it fully, but that was really the truth of it. I think on Twitter, and we can kind of talk about this a little bit. I think on social media Cardano gets this rap as Charles's like personal pet project that like is building all this code and it's all these scientists in a dark room, but actually people don't realize that like this thing is spread around the continent at this point, with over what, almost 2000 state pools, with a foundation in Switzerland that has business dealings with countries around the world, Emergo, and what they've done. I think that people don't realize the actual amount of bandwidth on the developer side, the community side, the investor side. I get texts from like other VCs, hedge fund guys, other banking, analysts who I talk to. I went to school with these guys. They invested in Tezos. Their hedge fund is long some of these proof of stake like Polkadots. They want to learn about Cardano staking. They're having too hard of a time just learning how to unstake or unbond in these other protocols. They want to learn more about ADA, right? And that means that we're just kind of entering that mature phase where okay, outside investors, outside actors can come into Cardano and take a real role in that. I think as someone who was here from the start of that process, it's kind of great to see 2020, like this whole community really mature, to get to that point. I mean, even talking about Liqwid, and I'm sure we'll get there, Liqwid couldn't have been a real concept in terms of the exact implementation details and how we want to use the Cardano chain and the features we get. Before we had all these things fully fleshed out, Liqwid in its current form just couldn't be a thing on Cardano. So
Yeah.
even in that, there's like the whole maturity of the chain and that whole process, and being a part of that, it's just awesome.
Yeah. So, I mean, in 2017, which is when I was exposed to it, we had a chain that
Yeah.
worked as something that you could use as, means to transfer and store value. But we had seven nodes that constituted the whole chain, and they were sort of, federated. And there were a lot of skepticism around the idea of whether Cardano is going to actually one day be decentralized, right? And they were doing active research. And I understand, like if you are a hedge fund, and at that point, you have you are looking at proof of stake as the next step, your options were limited. You had Tezos and maybe a couple of other ones, right? And Cardano was an active, even though it was actively researched, the code was not being written at that point. And I remember Charles Hoskinson getting a lot of heat about that. But my personal opinion and my personal assessment at that time was, there's no way that there's so many bright scientists who are lending their name to this protocol are going to one day turn around and say, oops, it won't work. So we're just going to pack up and go. Or things would, fail, even though, it's these building these kind of protocols is a risky in its nature, because it's quite new. Nobody else has done it. But still, I think they persisted. Then they refined. I remember their Ouroboros papers and reading all of them. And that's one of the things that you and I probably had as a luxury. It was the time we studied the fundamentals. That fast forward to 2020, all these concepts that are being thrown around. You and I pretty much understand it. But somebody who needs to just roll up their sleeves and try to understand things might have a little bit of a steep learning curve. But it is amazing that we have come this far, and we are building on the research that has been done, and we are introducing Yella again, which is a great concept. I think that's something that we need to talk about. Yella being an interpreter, a platform, sort of a language platform, or K framework being a platform where anybody with any K defined language would be able to write smart contracts. You don't have to learn another language, for instance. That's one of the greatest things that's happening in Cardano that is not fully grasped by the wider community. But yeah, so when you talk to the financial professionals, right? What is your general opinion when they talk about, when you expose them, or when you talk about cryptocurrencies? What do you think is the major impediment for them in order to look into this space?
Yeah, I think there's a few, but they're quickly being solved. I would say the number one is actually still just a general understanding of what digital assets entail. What is Bitcoin versus a blockchain, and what are all these other, 3,000 cryptocurrencies floating out there, right? And where does Cardano fit in that picture is like the really kind of macro explanation that, like, it's not easy to kind of even have the Bitcoin versus blockchain conversation, much less try to get these guys to really think meaningfully about, what proof of work versus proof of stake means, why proof of work might not even be that sustainable, and you kind of have to get through to that level of understanding, at least at a, high level, to be able to say definitively, okay, beyond the science, the research, the weekly technical reviews that we read for Cardano, this is why, the Cardano chain is going to win and be here in 50 years. Like, you really have to have some level of blockchain understanding to be able to kind of preach that to them. But I think at the highest level, financial people understand yield, and they understand the fact that right now we're in a world where bonds are done. Okay. The pensions that have their 70-30 allocated to equities and bonds, they're done, right? They're going to have a lot of trouble in the next couple of years because we have 16 trillion plus of, global debt that's just negatively yielding right now, or basically beneath, almost at 0%. So that's a huge problem for many different people around the world. And when I say pension funds, I mean there's trillions of dollars of wealth that are tied up in these bonds that have right now a zero yield. Okay. We compare that to the digital asset world, right? And let's just take something like staking on Cardano, right? The perfect example of a risk-free yield on a system. You'll never actually lose ADA by staking on Cardano, right? And you're always going to be able to earn something like 5 to 6, maybe even 7 if you're good, % interest every single year, right? There's going to be a day that's coming very soon where, and you can call it whatever you want, the search or the hunt for yield, like these financial institutions and large firms are truly going to be like running around, blindfolded in any asset class they can. Commodities, fixed income is not going to be there anymore. So equities, ETFs, whatever they can to find some real yield, right? To cover the fact that their 30% or 20% allocated to bonds are just not even giving them any, right? And when you put in inflation into that, that's a whole nother problem in a year like 2020. So there's issues that are happening in the current traditional system that's actually making first gold look super attractive. Let's be honest, it all flows through gold. And we were talking about this before we just started recording, Umed, about how that history of money started and how gold became this liquid asset that was hard, could be used at any marketplace that formed around the world. So it's going to flow through gold, and then it's going to flow through Bitcoin. But quickly, institutional money will flow into Ethereum, into Cardano, into these third gen blockchain, right? What exactly that path looks like, whether it skips gold and goes straight to Bitcoin, and then it's obviously a quicker flow into Ethereum or Cardano, what that looks like, and that very well may happen, I actually just don't know. But I do know that a major shift is coming when you look at just the amount of money that's allocated to assets that are yielding 0%, right? Like that in its own is a huge problem that no one is talking about. We now have 10-year corporate bonds in America that are yielding 0% or almost negative percent interest. Like that is a real problem that nobody wants to talk about, but we're really going to have to discuss pretty soon. And it's all just like a free advertisement for cryptocurrencies.
You
Again,
touched,
and here's my
yeah,
last point.
you
When
touched
you look
upon
at,
a
yeah, go
very,
ahead.
very interesting topic. Actually, let's just expand it a little bit. My fear is that with all this money being printed at this point, we've seen the inflation of um, equities, right?
Yep, yep.
Equities have gone back to their original pre-COVID 19 levels, and they might have actually they surpassed this. S&P 500 has surpassed. The composition of S&P 500 changed, of course. We have a skew towards technology companies, the FANGs, but it looks like in its path for yields and growth, the money has just overinflated the equities, because as you said, you can't go below zero in bonds. So you have to sort of allocate somewhere else in order to be able to meet your fiduciary duty. Let's talk about pension funds, right? They have target rates, and they need to meet those target rates in order to be able to meet their pension obligations. These are billions and trillions of dollars we're speaking. And when they look at the landscape of available financial instruments, bonds, real estate, you name it, equities at this point, things are really, they are really not that attractive, and there's two things that I think might happen in the future, and one is that we will completely rebase our pricing, because there's just too much money slushing around, and 2019's 100 S&P 500 is going to be is going to be a 7,000 S&P 500. It's but to your point, all of these pensions, they are starving in terms of yields, and there isn't enough growth in the real economy. And I don't know how soon it's going to come back. We have the COVID, and the vaccine available, coming into the market soon. But I think it will be a slow recovery, because all these businesses that went out of business or have suffered a lot, and we're talking about the major part of the economy, not big corporations, but the main street, the mom and pop shops that are the backbone of the economy. I think 60% of the U.S. economy is basically small businesses. When they start coming back, it's going to be slow, and we don't have enough of them in the stock market to be able to tap into them, I think. So what will happen is eventually the smart legislatures, legislative bodies will understand that they need growth, just like the way that we needed growth when internet came to be, and we opened up internet for commercialization. I think we're going to go down that path. So we are going to open up the floodgates for institutional money to come into the digital asset space in order to fuel the innovation. I think that's where we're headed. I heard today or yesterday, SEC opened up a special office for digital assets and fintech, and that's a very bullish sort of sign for this, a space, because I think they're willing to sort of look into this space as a separate sort of
Entity,
domain.
asset class. Yeah, yeah.
Yes, because it is, you can't just lump it into stocks or bonds, because it's completely different. It has different properties. And what will happen eventually is that money will come into this space hunting for different kinds of assets. I created Oculent, which is another company that I own, as a research house, in order to make sense out of all these digital assets. And I may have been just a little bit too early, because I opened it up in 2017, 2018. Expecting that the institutional money will have to eventually come. But, I think this is where we are headed right now. And when the institutional money comes, they will need differentiated research in order to make sense out of what they're buying. Because right now
Absolutely.
they're not even aware of what they're buying. I think they just spray and pray kind of strategies by some hedge funds that I've met in New York before. They just basically say, okay, I just want to get an exposure to this space. I'm going to take, okay, top 10. I'm going to just do a naive diversification, basically 1/n, and let's see what happens.
Right.
And with Bitcoin being so correlated with other assets, maybe that's not such a bad idea at this
Right.
point. But I think things will decouple really fast when the real money comes, and when the on-ramps become more available for institutional investors. What do you think about registered investment advisors? Do you see an uptick in interest?
You brought up some good points here that I wanna hit on before we get to that. So the whole concept of like this ETF, like, diversified asset basket of digital assets, I think that's coming actually. When you look at even Zoomers or millennials or whatever you call us, I think that they did a study of the top stocks that like millennials purchased basically in 2020, and then I think it was like Netflix, Apple, Tesla, some other thing, and then it was actually a Bitcoin. It was like whatever product I think that maybe Grayscale offers that you can purchase on maybe one of these exchanges. I don't think it's like Nasdaq or something. I don't know where it trades, but basically that made as the top five. That was the fifth most bought stock, and it's just like a Bitcoin IRA type of deal that you're buying basically.
Yeah, it's
So
actually selling at a huge premium too.
yes,
So
it
they're
is. Yeah,
making a
so
lot of
it's
money.
to think about that. So you're going through, you're buying something at a super premium just to be able to get exposure to Bitcoin, because it's that hard to just say, hey, I want this in my 401k, right? Imagine when we make this super easy to say, okay, here's not even this IRA type of funky product. Here's just direct staked ADA that's being wrapped into an ETF with maybe the top five proof of staking network tokens, right? That's where we're heading in the future. And like, I think it just takes a couple more years before we get there. You talk about regulation. I think that the interesting thing about Bitcoin, right? And we can kind of talk about this and transition into proof of stake and liquid. But the interesting thing about Bitcoin from a macro global perspective is if we, like when you talk about regulation in America right now, and even Cardano, right, where the foundation is in this proof of stake alliance, right? And that is saying, okay, we got together with Cosmos, Tezos, Polkadot, and some other proof of stake chains and said, we're going to lobby, the SEC, we're going to lobby the House of Reps and like literally the US Congress to treat proof of stake tokens and tax implications that are tied to them more friendly, right, than maybe we could have if there wasn't a group lobbying for them, right? So that's the whole thesis behind why we're in this thing called POSA, right, proof of stake alliance. The letter, if you actually read it, what they wrote to the Congress, or what Congress actually wrote to, I believe it was maybe the SEC, or how we should, or actually, I'm confusing this. Congress wrote a letter to the IRS. The letter was to the IRS on the tax implications of basically the staking rewards that you earn each epoch for whatever staking system you're in. And actually, if you read the opening letter, they're posing proof of stake as America's gateway into public blockchains and crypto as a way to basically equalize the dominance that China has right now in proof of work with Bitcoin. And that's actually exactly how they pose the entire kind of need and impetus for Congress and IRS to treat the taxation of these proof of stake cryptos way more friendly than they otherwise would have. It's actually not just because they think this is the future tech. It's also because they understand that China has such an advantage in the hashing power and just the infrastructure they've built around Bitcoin at this point compared to America, that the only way America is going to have a meaningful say in the rebirth of the decentralized internet is going to be through these programmable proof of stake networks, which honestly, if we're being real, these programmable proof of stake networks will likely have, way more utility in the long-term future than Bitcoin. I liken it to, do I use my Venmo account or my gold in my, my vaults more each day, right? So it's like, it's that kind of, I guess, discussion. But the other thing is, okay, you look at North Korea, they were a very early mover into Bitcoin. Are you really going to think that the West and America is going to allow Bitcoin to go to $1 million and allow North Korea to get ultra rich overnight? I just don't see that scenario playing out. So like, yeah, the Bitcoin guys say 100x, it's going to happen. We're going to 1 million plus. Like, yeah, maybe it could happen. I'm not even ever going to doubt that out, right? Because Bitcoin is the OG, much respect, and I love Satoshi. He's awesome, right? He or she is the reason that we're all here today. But when you look at proof of work, when you look at the amount of energy they burn, when you look at how it scales over time with the increase in the cost of Bitcoin, it's like, do you really think that we're going to just allow some of these rogue nations like North Korea to just go rich with Bitcoin at $1 million? I much more think that Bitcoin's going to get to this kind of low volatility place. It might be 100K, it might be 250, it might even be 500,000. I don't know what that number is going to be, but I don't think we're going to see this like Bitcoinization of the world that everyone kind of talks about, because blockchain tech has advanced in 10 years and Bitcoin for the most part really hasn't. Like, they're just implementing notions of privacy and it's 10 years plus later, right? So, and on top of that, all these other global macro plays, like I just don't see the whole proof of work winning out long term that people think. And that's why my entire portfolio, always in crypto, has always been proof of stake, right? Whether it's been Cardano, and obviously Ethereum is moving to it now, but now it's all just Cardano, because I'm saying this is my bet. I want to be on the fastest horse and I want to be on it, right? And to me, it's ADA. So it's that's kind of how I view the whole space of proof of work versus proof of stake. But
Yeah. I think if we go into the comparison of Cardano with other technologies that are out there, granted, I haven't looked at Polkadot or Tezos that deeply, because I'm quite busy running a stake pool and being very active on the governance side of things in Cardano, because I think we are entering a very critical moment and critical sort of period in Cardano where active participation is quite crucial, and Cardano members, community members who are interested in these aspects of the protocol need to step up and make sure that they contribute and their voices are heard. I think if we compare Cardano with other Tezos or Polkadot, and again, I'm just basing my opinion based on anecdotes that I've heard. Cardano is much more seamless. I think you don't have to lock anything. You don't have to be as a stake pool operator. You don't have to be afraid that your stake is going, your pledge is going to disappear because somebody misbehaved, or you could get attacked. I mean, it creates that attack vector, right? You think about the outcomes. You can just say, all right, if I am a bad stake pool operator in some other proof of stake protocol that actually slashes your stake if you misbehave, then it provides incentives for other people to actually attack other pools. And that's another thing that I talked with Duncan. It's just so amazingly well thought out that they went to a great extent, game theoretically, to eliminate all the possible attacks that stake pool operators could mount on each other. And one of them was, how do you redistribute the amount of stake that is not actively staked, right? So on ITN, if you remember, all of that was kind of distributed to the pools that were staking. So we kind of got more money because of the fact that the stake was not participating. In the main net, that goes back to reserves.
Right.
And it's such a beautiful, very elegant way of handling game theoretic motivations or incentives to actually make the protocol, you know, it handles the negative effects of what could have happened if we did not introduce these measures. So you know, if you think about other protocols, and I don't know about what's happening with Ethereum, but it looks like they constantly are hitting some roadblocks that I thought if you hired scientists, you could have completely eliminated those. You know,
Yeah.
it's
I read that recent article from, I think it was the chief scientist, Angelos, and he basically talked about how the staking works in Polkadot and Tezos and kind of the different schemes that are being used in these systems versus Cardano. And I agree, just the simplicity, the elegance of the way you can either enter a staking pool or leave it. The notion of slashing and the fact that you don't even need it in a truly robust system like Cardano. And I mean, when you look at the total value that's locked in, or you can call it locked, but really, is it ever really locked unless you're a pledge, right? So the total value staked in Cardano compared to these other networks, it's like, way more. The only thing that compares at this point is ETH2, right? So let's just be real. And ETH2 has what, a 3-year head start on Cardano at this point.
and a market cap of 50 what,
right,
60 billion or whatnot, right?
So, yeah, exactly. So I think that we clearly this is Ouroboros is a huge win. Even Polkadot itself is using a notion of Ouroboros and then decided to complicate it more for no reason to introduce their staking system. So it's like, and I don't even mean it to bash because I wish them all well. I really do think that in this space, a rising tide is going to lift all boats. But I think that, okay, a rising tide, but I want a fast horse that's on that tide. And I think that Cardano is the fastest horse. So that's where we are, right? And, we can transition into what we're doing with Liqwid. And you kind of talked about something with Yella because we're actually planning on using that DevNet and potentially even using the Yella to build our V1 in Solidity. So a lot of what we do actually, and how I think, just even as an investor, as a DeFi analyst, whatever, it comes from, okay, there's certain things that Ethereum has right now as a result of being 3+ years early or whatever, and just having some of the mind share and dev share they have now. You can use these systems, learn from them, and then realize that Cardano is building a base layer protocol that's like comparing building on granite to comparing building on quicksand, right? So the things that we're planning on introducing, like truly out of the gate, are things that you really couldn't do on Ethereum, right? And some of those things are like dividend models and actually being able to introduce a dividend from day one that's tied to the protocol. Like there's no DeFi system on Ethereum that can really do that. Why? Because the transaction cost to use the chain is just way too high. That would just never be feasible. In Cardano, that's a realistic thing that you can introduce from the start. And then you talk about, real traditional finance analysts coming into DeFi and valuing your protocol, your token off of, the dividend, theory, basically the dividend policy, whatever that, however much dividend you give over time, you can use it to value the entire market cap of the protocol, right? So
Exactly.
These are things that I actually, and our product lead, we were just on a call with our chief strategy guy and our product lead, and just talking about what does it look like to go from, okay, you're building something in Solidity that's going to run on Yella, but actually in the end of the world, it's all compiling into Cardano or Boris land. Like, the stake pool operators are still running all of our smart contracts, even though it's programmed in Solidity technically. So what that actually looks like is it's just a huge efficiency and cost saving across the board because we don't have to worry about, all of the just basic costs to do simple things on Ethereum. They're like, basically they round to zero on Cardano, right? Whereas they're very serious, meaningful costs that you have to try to predict for on Ethereum.
Yes. Dewayne, let's just go and delve into your product and Liqwid. Can you start from the beginning and let our viewers and listeners know what Liqwid tries to do? Just basically in a very, elevator pitch type, sort of a format. Tell us what Liqwid does from an end user's perspective.
Yeah. So Liqwid aims to provide a borrow-lend protocol on top of Cardano's blockchain. So if I have some ADA or another asset that's living on Cardano and I want to earn interest on it, or if I have some assets that I want to use as collateral to take out a loan, I can just engage with the Liqwid protocol. One of the pooled basically liquidity pools on Liquid, whether it's for ADA, whether it's for a stable coin on Cardano, right? I can engage in these markets to become a lender and earn interest, or a borrower and take out a loan. So there's similar kind of notions of this kind of DeFi lending on Ethereum. Compound is one, aave is another. DYDX is margin lending, so you can use it for derivatives and things like that. But the concept of lending kind of really goes back to like a core feature of banking, if you will. Like when you go to a bank, right, you deposit your funds there. That bank is, allowing other folks to use your assets, pay interest, and then giving you a small subset of that, right? That's the basic notion of what a bank does.
So you are, in essence, creating a decentralized bank.
In essence, yeah. If Cardano already wasn't a decentralized financial system, now we're going to create a decentralized bank on top of it, pretty much, yeah.
Yeah,
and it's more than that. Sorry, I didn't want to cut you off.
Yeah.
It's I try to think of it as like more like decentralized liquidity, because yeah, you can build the bank, and lending and borrowing is like on the risk curve really at the bottom. Like it truly is like the most basic of implementation. Like when you go up on the risk curve, you start talking about the Uniswap type of, actually asset swapping and trading. And you can do that on Liquid, in a future version of the protocol. The same liquidity that's being used to allow other, borrowers to come in and use those assets, that same liquidity can be put in a, adjacent or same pool to actually swap those assets. That same liquidity can be used to introduce things like derivatives and even ETFs. So there's a future version of Liquid. There's a V2 of Uniswap that introduced future things. There's a V2 of Compound. So all of these protocols, they aim to actually just build the foundation. In our case, that foundation is liquidity on chain. And in the future, you can do really cool things and introduce features that are all kind of tied to that liquidity that you've managed to basically build on chain. So that's what liquidity is.
Let's talk about version 1, the one that you're building right now. Who is going to be the borrowers in
So that's a great question. I mean, the borrowers are anyone, right? I mean, we have ideal use cases. We see stake pool operators who want to, put up some ADA and then take out a loan against that to maybe finance their cost of running their stake pool. There's many different use cases. Anyone who's holding ADA or holding a stable coin on Cardano who wants to either, use that asset to go longer or to go short against it, who wants to use it to finance an investment or even finance their stake pool, like I just said, right? Like these are all users who would be ideal borrowers in the system. The whole notion of the V1 protocol is what we're building is in traditional finance terms, you would call it a fully collateralized credit facility.
Mm-hmm.
So what that means is everyone in the system is over collateralized, right? And usually a collateral factor of something around 70 to 75%, right? So we're saying for every $100 worth of ADA that you put up, you can borrow $70 to $75 worth, right? You go over that limit, you are technically in what we call under collateralized world. And you're basically at that point at risk of getting liquidated in the system. The whole entire system basically works because you have liquidators who can earn a discount by liquidating all of these basically underwater contracts. So we see it as a default risk to the protocol when you have a loan outstanding that doesn't have enough collateral to back it. So we're allowing liquidators to come in, take 5% of your base collateral and pay for your loan or the amount of your loan that's now under collateralized. So it's a very kind of sophisticated, simple contract call that we're able to build because what you're saying is anyone can build a liquidation bot around that. We'll probably build the initial ones, right? Any trader, any dev, anyone who wants to be an arbitrage, it's like a trading strategy at that point, right? You can take this contract call that we'll provide and basically anytime the system now has an outstanding loan that becomes under the collateral limit, anyone can call that contract with the address and some ADA in it, and you'll basically pay for that person's amount under collateralized. So that's in a nutshell how the entire V1 actual system is going to work. You can deposit, you can borrow, and you can liquidate assets. There's a governance module as well. There's a whole notion of the folks who are actually using the protocol being able to govern it into the future and kind of what that looks like and means. It's actually really key for us because when we started Liquid, we never started a company. There's no VC investment. This is truly a decentralized organization that from day one, we're saying we want to put this in the hands of the community. And right now the community is Cardano, it's Project Catalyst, it's the folks who are engaging with us on the Liqwid Discord channel. So it's everyone who's a part of this project up to this point. It's the enterprise developers like Twig and App Invented that we've partnered with to, help us, in addition to our core devs, add some developer bandwidth. So it's all of these different players that are kind of involved in the development of Liqwid right now that we want to be a part of governing the future. And yeah, there's going to be a token that's going to, help us align those incentives and actually implement governance. But what it really means is, we can be a DAO first model and not have to go the whole LLC route, the whole traditional startup route, if you will.
Okay. Now, when you were talking, I kind of started thinking about, if you kind of tie back the role of Liqwid in attracting sort of capital, I started thinking about these pension funds, right? That are looking for yields, and I also started thinking about all these emerging markets where, in order to get a loan, you have to pay 20% in dollars, right? 20 or 15 or whatnot. And I started thinking this instrument could be a really good way of bringing those, this liquidity supply and liquidity demand together and creating a market that has an actual price that reflects the reality, right? So for somebody who has a bunch of US dollars, let's say, USDC, right? And just create this a digital form of US dollar, instead of letting it sit there and collect dust or get 0% or maybe even negative in some cases, you could actually earn 7 to 8% per year. I mean, and it's US dollar, right? You're not taking any risk with the, that's over and above the US dollar risk. And you would kill for yields like that on equity in the United States, right? Dividend yields or whatnot. So, and here you have a guaranteed sort of way of getting those, yields. I think there will be a lot of liquidity, coming into this space like that. And on the other hand, of course, you have all these nations that are starved, they don't have enough dollars, right? That could actually access that liquidity that way. And you mentioned that, the initial sort of applications would be probably something that you could use on chain for probably trading, etc. But I mean, do you think you could extend that to become a loan to an agriculture, to a set of coffee producer somewhere in Ethiopia? Could that evolve into something like that?
Yeah, I mean, so there's many things there. The V1, yeah, we talked about it. It's going to be very vanilla and look like a compound, just simple borrow lending on chain. But in the V2, right, when there's this notion of, and I've talked to our product guy Florian about this a lot actually, there's this notion of uncollateralized lending, because that's when you're really competing with like the current banks, because where they make their money is not actually over collateralized lending. Like, it's not mortgages, it's actually being able to offer under collateralized or zero collateral loans. And you talk about the user in Nigeria, right? When they go to these loan apps or when they go to a bank to take out a loan, what they're actually being what they're being kind of sold is a zero collateral loan almost. So they're entering as a borrower and they're not putting up any collateral at all. Now, the price of that is, like you said, it's 20 to 30% loan origination fee. It's high interest rates that are variable usually, but like super variable. It's fixed payment terms and high costs that are embedded in that if you miss that. So all those things that you end up paying like a 200 to 300% APY on that loan because of that scheme. And we call it a payday lending scheme in America, but whatever you want to call that scheme, right? It's like, okay, it's zero collateral lending, right? And I want to be able to introduce a feature, and it's going to be in the V2, but we could say this: if we white label with a bank that actually is able to offer a zero collateral product, because you actually do need to have a credit license, like to be able to offer zero collateral loans, like that's like a whole, like, and it's across jurisdictions. You really do need a banking license to be able to do something like that. But what you actually can do as a DeFi protocol, you can white label by partnering with the bank in Nigeria or Australia or Ethiopia and say, hey, you guys already offer zero collateral lending. We can integrate through Atala Prism that's already set up in the Liqwid app to basically white label this bank's whole compliance and regulation to enable you to offer using liquid liquidity, right? So the capital that we've put up, you can now integrate with your bank's compliance and regulatory processes to approve borrowers to actually have 0% collateral loans. So at that point, what the liquid borrower is getting is they can now open a 0% collateral loan. The bank is now getting a borrower who they never had access to before, right? So banks always have the means to give out loans. They never have enough customers who
Liquidity.
want to open up loans, right?
Yeah.
Who are at least eligible, who have good enough credit, right? So that's always the hunt for banks, right? You can basically align all of these different parties to offer that specific product. And in the process, you're saying, okay, you're a coffee farmer in Ethiopia, right? You might not have any collateral you can put up in ADA or US dollar coin, but you do have, a record of your, past 6 harvests, and you can kind of show us your ability to, produce and work with other farmers. Maybe you even join an alliance, right? You can then put that somehow into your Altala Prism, like make that an organization or a part of their kind of past experience, allow the bank in Nigeria to handle all of the regulation and compliance side of this. So they're actually validating the Altala Prism. They're validating that that person is who they say they are. They're verifying their identity. Everything that you basically need this banking license to do to be able to offer a 0% credit feature, they're doing that for you. And then you're hooking into Cardano and our liquid pools to say, okay, here is where you're actually getting those borrowers. Here is where you're getting, the actual capital to supply them. Really, the only function the banks are giving us at that point is white labeling compliance and white labeling identity verification. How much you need to pay the banks to do this is the real question. And whether the banks actually should pay us for this integration. Like there's some things that are still outstanding. You don't know how this exactly plays out. But let's say it's something that you'd have to pay for, okay? So you pay for a one-time integration with the bank. And of course, they're going to want something like this because it's making their job, it's giving them new customers that they didn't have access to before, right? For the liquid saver, who's actually supplying the US dollar coin, they're now getting access to a loan that's going to inevitably, like out of the box, these 0% collateral loans are going to carry a higher interest rate. So if you're paying 2 to 3% interest to borrow normal stablecoin on Cardano and Liquid, you're going to be paying maybe 10 to 15, maybe even 20 if it's your first time, borrowing a 0% collateral, depending on the actual bank that we white label, right? And that's kind of just inevitable, right? Higher risk levels, you're going to pay a higher interest rate to borrow uncollateralized. And that's in line with credit cards and things like that, right? So what we're saying is there's higher earning potential for the liquid lenders, right? They obviously want to be a part of uncollateralized lending because for them it means, okay, yeah, you're moving up a little bit on the risk curve, but you're white labeling it through this bank. So the people who actually get the loans are going to be secure and verified identities. And you're going to be earning instead of 4 or 5% interest, potentially 15 to 20%, right? And the banks are going to take a small percent cut out of that as well. So that's the play in V2 and V3 of Liquid, right? But there's some things you have to do to kind of establish yourselves to get there. And we're on that path right now in terms of the initial development.
That's fascinating. I mean, that's exactly where I would like to see the protocols to develop and go, because at the end of the day, that's just one thing that I've noticed in a decentralized finance in Ethereum is that they are rediscovering the concepts that you and I probably know from the get-go, but they are rediscovering it and trying to reshape it in a different shape and form. But the concepts, they remain the same. As the risk grows, the interest rate grows. And as you de-risk your loans with collateral, you can borrow at a lower rate. I mean, that's inevitable.
Right.
As you said, the integration with traditional finances is something that needs to be addressed. I hope we will have some really good frameworks, whether it comes out of your work with banks or some other way from the legislation when they decide to actually look into this space. It would be very interesting to actually watch this space. My personal observation in this is that SEC is in an interesting space. For them to basically say the digital assets are a security or some form of asset that they need to regulate, will give this space the legitimacy to actually be, accessible to 401ks, et cetera, et cetera. So I think, maybe but if you just keep ignoring it, then, it will just develop on its own. And eventually you will have to recognize it. That's the thing. This space is evolving so fast. It's amazing how in my entire career as a finance professional, and I've worked with different organizations and banks, I haven't seen this level of innovation take place in finance. And honestly, I felt always that we needed to do more in order to bring banking into the 21st century. And there were attempts to do that. You talk about E-Trade, when they came out, I thought that was great. You could trade with your phone, et cetera, et cetera. But even then, there was something that's lacking. And I think decentralized way of managing your money, and you could regulate on ramps and off ramps. To your point, by the way, of regulating Bitcoin, Bitcoin itself could go up to whatever it needs to go, but if North Korea does not have a way of liquidating these assets and getting the money out, they're kind of are stuck, especially if the intelligence agencies identify those wallets that are connected to rogue nations. Then it becomes basically impossible. And these notions of like, oh, I'm gonna just hack an exchange and take some Bitcoin or Ethereum, it's kind of a moot point, because your coins will be tainted and they will be tracked. And you will get caught. So there's no reason to do that. So,
I could play the devil's advocate though and say, with Bitcoin adding CoinJoin and some of these other things to give privacy to the actual protocol, you might have a North Korea that's actually has private Bitcoin on the network that they can sell off in little batches. So there's both. It's a real problem for Bitcoin. I'm not gonna lie. It truly is. It's unaddressed. The whole China hashing dominance. We kind of like, Blockstream doesn't like to talk about it. It's not their favorite topic. Cardano, you just don't have to deal with it. All of the damn sig pools in China got shut down because China went hard on crypto, or in India or some other nation. Okay, we'll have a couple more spinned up in Japan or Southeast Asia somewhere. So it's like there's this whole ephemeral nature of proof of stake networks that proof of work will never be able to have. And, I do agree with the privacy thing. You might be able to at this point in time, if North Korea publicly has a lot of Bitcoin, we could probably track it and trace it and make it basically black.
No, I mean, look, if they introduce the privacy sort of protocols and privacy sort of solutions, and that becomes a problem. That's for sure. But I think my biggest sort of concern, and I really respect Bitcoin for wherever it's done. I mean, to be honest with you, when I entered the space, Bitcoin was the hardest sort of cryptocurrency to use, because I was trading arbitrage in 2 exchanges, and my first mistake was that the Bitcoin settles immediately, right? Or whatever, 12 minutes. Or what was it, like 5 minutes or something like that?
Confirmations,
Well, it turned out that it takes an hour, right? So I found out that there's 2 exchanges first. I mean, that's what, I got excited about this whole space. I wrote a small script in Python. I hacked this whole thing, and it would let me know that I have a 5 or 4% sort of arbitrage return, risk-free, right? Between exchanges. So I just buy and sell. The first time I tried it with Bitcoin, I did not do well, because it took an hour to settle. And by the time it settled, the price moved and I did not have anything. So, and then I moved to Ethereum because it just settled every 15 minutes. So the window of exposure got reduced substantially. So I made some money that way. Back in the day. But my biggest problem with proof of stake, proof of work, is that the amount of energy it will take, if it just goes the way it is, it will to actually create a Bitcoin is going to be just, at some point the chain will halt, because it's just not feasible to just have that much hashing power and waste so much energy to squeeze out the price will have to go up. If this chain needs to exist into the future, the price has to go up, because otherwise there's no justification for getting a fraction of a Bitcoin, spending enormous amount of money. And at some point it will stop, I think. It's because like a game of musical chairs. But by that time, I hope we will be able to sort of port Bitcoin because it already has some sort of value and into other chains, and that would exist in their current form or whatever, and their form in other chains without the Bitcoin chain moving. So it,
I
we
think
were
that's
talking about
exactly what
Nepo
was.
powers, right?
Yeah, right,
So if
right.
they exist on Cardano and they can be moved really easily and they have their own sort of value, and you can just verify that that Bitcoin existed at that point, then it becomes basically a coin without a chain kind of thing. So I
Right.
don't know if that is going to basically have any value, but that's probably
Could be a side chain too. There's a whole notion of, okay, it could be a side chain, and then you tack on NEFA pals. Now you have all of Bitcoin's liquidity talking to Cardano pretty easily. We'd love to have a liquid Bitcoin market. Like, we'd love to have a liquid Ethereum pool, right? Like, there's concepts of, okay, there's major pools of liquidity, even though the Bitcoin network is really just push and pull at this point. How does, like, that's why you see all this like WBTC and like things on Ethereum where you're trying to unlock that liquidity. And it's no different than what we see in centralized finance, where you build products around gold to try to unlock gold's, massive liquidity, right? And you do interesting things with that. So it's the same concept. We're just taking a very simple asset that's super liquid and trying to basically use it in our programs that are like very much so upgraded. I think in the future, like you said, Bitcoin's going to have a major problem because, yeah, burning as much electricity as Switzerland right now is fine. But what about when you're burning, half of what it takes to power Russia? Like, because that's where we're heading. Like, and once that's the reality of this whole thing, like 5% of world electricity being used on Bitcoin, that's just not going to be a thing. Like, there will be, I guarantee, state attacks, for better or worse, to shut that down. Now, hopefully before that, you see Bitcoin go green. You see, some major shift in the type of, just the way mining is done today towards the future. You need to see a shift in renewable energies. You got to see it go hydro, go green. It doesn't even matter. Go anything, right? Go nuclear. I don't even care at this point. But you cannot keep saying the current output of electricity is just gonna power Bitcoin 30 years, not even, I don't think, a decade into the future, to be honest. So
yeah.
we'll see. We'll see.
Yeah.
It's gonna be interesting.
Well, thank you so much, Dwayne, for coming. I'm trying to basically get my guests to make a prediction on the price of ADA every time they come. So I just started this trend. What do you think we are going to see as a price of ADA by the end of this year and by the end of 2021? What are your predictions?
Yeah, not a great prediction guy at all. So I'll preface it with that. But I would say by the end of this year, what's ADA, like 15.5 cents right now? I'd give it like 30 cents by the end of this year.
All
I'm
right.
bullish on December. December is usually a good month. Not last December, but December has historically not been a terrible month for some cryptos, especially towards the end of it. So let's say around 30 cents.
All
December.
right.
End of next year, I would say at least all-time high. So at least $1.40 by end of 2020.
All right. All right. Well, thank you again for coming, Dwayne. I really appreciate talking to you. It's always a pleasure to talk to you. It's great that we have you in the community, and I wish you the best of luck.
Thanks, man. It was a blast. Happy to come on sometime when Liqwid gets further in development as well. Thanks,
Absolutely. I will have you on again, I'm sure.
Absolutely.
This marks the end of our episode today. I hope you liked the interview and the type of content that we're putting together. And if you do, please do not forget to subscribe, like, or comment on our videos. It really helps us a lot to build awareness about Sloth Leader. I'm your host, Umed Saidov, and I will see you next time.